Today's presentation is going to be on high-frequency trading. And for those of you that I spent some time talking with, and for those of you that know me from my analysis on dailyfx.com, is I typically always stress the importance of trading more medium term, and certainly that's the style that I like to take. But for those of you that are more familiar with the things that we have on DailyFX, is we do host Trading the News, which is certainly some speculative trading there, and I definitely look towards more of short-term charts and short-term trends in the market. And as a result, based on all the things that I've experienced while trading, is sometimes the market conditions are very favorable for scalp trading, and those are typically the times that I like to scalp trade, and certainly that's the reason why we host these Trading the News events, because it comes out during a time where market volatility is definitely there. We like to see a lot of volatility whenever we trade, and at the same time we have the liquidity that we need for our entries to really get triggered on time and at the levels that we want. So, but today's course is basically just going to be on kind of what's involved when we're trying to trade on an intraday basis, as well as some techniques and some things that we want to look at when we're trying to scalp trade at the same time. But before we begin, like trading any leveraged financial instrument, trading FX involves a high risk, and as a result, we always recommend that you know your risk before you even attempt to trade, and you should know what you're doing even before you decide to put your real money on the line. So because FX trading involves leverage, leverage can often act as a double-edged sword. Certainly it does have the prospect to increase your gains, but at the same time, if we see an adverse move that's really not in your favor, that could certainly increase your risk for loss. So one thing we always recommend is know your risk, and we really want you to know what you're doing. But since I'm talking to more of an advanced group here, I won't really go through the whole thing, but I certainly encourage all you guys to take a minute and redo this when you do have your time. Yes?
Can I ask you a question?
Sure.
Would you tell us your definition of scalping so that that I understand the context that you're talking about?
Sure thing.
Previously, you just mentioned monthly charts. That's an oxymoron.
Yeah.
Scalping on monthly charts.
Certainly. So just to answer your question briefly right now, and we'll certainly get more into that as I go through the presentation, but scalp trading is just when you're really not looking for any long-term trend or medium-term trend in that fact, but you're just in the market on an everyday basis just to sort of pick up the ups and downs that we see on a day-to-day basis. So essentially, scalp trading can range anywhere between what we do at dailyfx.com, is where we have these news events cross the wires, which sparks a lot of volatility in the market, and we try to trade it in a way where we minimize that risk for loss, but at the same time, we're trying to pick up some quick gains, probably within maybe even a few minutes to maybe even a few hours, but it really depends on everyone's style of trading. And I'll continue to mention that my favorite way of trading is I typically like to trade for a few days to maybe even a few weeks. But there are times where I look to scalp trade, certainly. And the one thing I'm definitely going to be going over here is if you're looking to scalp trade and you're very interested in it, there are certain conditions that you could look for that are very favorable to trading on an intraday basis. So what is scalp trading or intraday trading? Basically, all we're looking for is an attempt to extract small but frequent gains in the market. And all we're trying to do is when we see, typically taking an example of the euro dollar, when it's holding a 100 pip day range, we would certainly expect to see maybe we might pick up a few pips out of those movements within a single day. But at the same time, what we're really focusing on is more of the short-term price action that we're seeing. So as a result, we certainly would not want to be looking at some of us. When I do host these Trading the News events, I typically like to focus on a 5-minute chart. But for those of you that have joined my colleague, John Kigleiter, he tends to look more at 15-minute charts. But again, this is all depending on the way that we trade, and it really depends on your style of trading. And one thing we always recommend is know yourself and kind of know what works for you and what doesn't. So when we're trying to trade on an intraday basis, there are certain advantages, and one advantage is it really removes the guesswork of trying to identify the long-term or the medium-term trends. So as a result, we really don't need to pay too much attention of where price might end up maybe a week from now, because we're just more focused on what's going to happen today or maybe in the next hour of trading. So basically, there's two types of day traders that we have. We have the institutional trader, and we also have the individual trader. And certainly there are two keys to this, because institutional investors really have high capacity to execute trades. They typically have multiple traders sitting at their desk just monitoring price action all the time. But when we're an individual investor, we really have limited trading or computing power, because typically we might have a few monitors set up, but we only have 2 sets of eyes where we can only see one monitor at a time. So first of all, just that dynamics puts us at a disadvantage compared to what a lot of institutional investors are able to do. At the same time, they have greater access to resources. So typically, when we see any investment bank, if they're certainly speculating on the market, they certainly have the power or trading capacity to actually jump in real quick and jump in out very quickly. But for most of us that are individual investors here, we really have a lower level of funds where we really want to take some trades that, and of course we're always trying to trade because we want to make money. And certainly sometimes we're very limited in doing so, because let's just take, for example, if we take some quick trades on the day and we already down 10 of our trades, that certainly has taken a big impact on our account. And some of us might just end up giving up after that, and we might just try to soak in those losses after we take a big loss like that on our accounts. So first thing I want to discuss is trading costs. So whenever anyone's trading, and this is the same for institutional traders, is trading cost is always going to be something we should always price in, or we should always expect when we're trying to trade on an intraday basis. So here's just a quick table of the typical spreads that we see. So one thing that we see here is more liquid currency pairs, such as the euro-dollar. The typical spread that we see, and this is all from FXCM's website, is we typically see a 2.3 pip spread. But essentially, if we're trying to trade on an intraday basis, and we're typically just trying to pick those little ups and downs, realistically, we might just want a 20 pip target, and that might be all we're looking for. But in essence, what happens to our net profit, because we have those costs associated, is we see that in reality, we're only able to pick up 7.7 pips. But one thing to keep in mind here is, as we go down the line and we get to more of the exotic crosses, such as the dollar, the USD, Hong Kong dollar, or as the US dollar and Turkish lira, when we see these costs associated with it, we see that for the Turkish lira, it's actually at 9.2, but at the same time, the USD HKD is all the way at 18.2. So first thing we want to do is, what currency pairs are we going to trade? And that's really what we want to look at. And that's why, for those of you that were in my previous presentation of trading the news, when I look at to trade the news, I typically like to focus on the major currencies that are really associated with the US dollar, because they tend to be the most liquid out of all the major currency crosses. So one thing we could see here is, if we really want to be successful, or if we're really inclined to trade on an intraday basis, you definitely want to pick a lot of these currency pairs that have less costs associated with them. So here's a quick checklist for individual investors. First thing we want to look at is market volatility. So again, market volatility is a good thing for traders, especially if you're looking to trade on a day-to-day basis. And if you're just looking for those quick ups and downs, we certainly need that volatility in order to reach our targets. But at the same time, one thing we also want to look for is tight spreads and costs. As I just showed you with the chart before this, if we do have higher cost of trade, that certainly weighs on our profits. So we definitely want to pick certain currency pairs that will help us maximize that the potential for profit. But at the same time, another thing that we're going to look at, and this is certainly a dynamic of the FX market, is the best trading hours. So because the FX market is traded 24 hours a day, there are certain times where market liquidity thins out, but at the same time, there's times a day where market liquidity is at its peak, and certainly if we're looking for those high level of volatility, we certainly want to pick the hours where we see a lot of liquidity as well as a lot of volatility flowing through. And at the same time, I'm going to go over some technical indicators as well as some technical strategies that we've tested out at Daily FX, and certainly there are some caveats to all of them, even though sometimes they are profitable given certain market conditions. So the first thing I want to go over is with market volatility. So for those of you that are not aware of this, this is one technical indicator that I look at every day, which is the average true range. And basically, the average true range is just the moving average of the true range of a given period. So typically, I like to use a 14-period ATR, and that's typically by definition, and I just know that a lot of market participants use that, and that's why I like to look at the same things that everyone else is looking at. And basically, all it is, it's an absolute value of today's high and yesterday's close, and it's also today's low and yesterday's close. So just by looking at the ATR, we could kind of gauge of how much does this one currency pair move in one day. And just by knowing how much it moves, we could certainly set a better target or more of a realistic target of what we can expect. And it all depends on your type of trading style, because when I'm trading the news, some things I would look for is maybe just a 20 pip gain. Some of you might actually look for a 50 pip gain. So it all really depends on your trading style, but by using this, it just helps to gauge overall volatility in specific currency pairs. Yes? No, it's basically the absolute value of today's high and yesterday's close. But in vice versa, it would be today's lows versus yesterday's close. Mm-hmm. It's the last 14 days. The last 14 days, yeah. Yeah. It's the range. So it's either, if we see an upward move in the exchange rate, that would be from yesterday's low to today's high. Today's high from yesterday's close. That would be that upward move that we saw. But if we see a down move in the exchange rate, that would be today's low from yesterday's close, which was higher. Yeah. Mm-hmm. Mm-hmm, mm-hmm. Yeah, it's 14 days. Yeah, it's a 14-day moving average of that calculation. Yeah, so it's just taking the absolute value of the highs to the lows, basically. Of basically from the previous day's close to today's high or the low. That's all it's saying. So we're really taking into account to what happened at the close of yesterday and what happened today. So taking a look at what's happening with the ATR, and here's just a quick example of what happened with the euro dollar, is during that financial crisis period back in 2008, we actually saw the ATR jump all the way above 300 pips, and that's when we really saw a lot of movements in the exchange rate. And typically what we expected on days during that financial crisis is we expect the euro dollar to move at least 300 pips a day. And certainly that gives a lot of room for us to make money, but at the same time, it really raises the risk for losses. So one thing that we clearly see here in the ATR is from above 300, it's moving all the way down now. In 2008, it actually was holding, in the first half of 2009, it was holding right around that 200. But one thing we see is it's actually tapered off, and it actually peaked around that 150 pip level. But now it's starting to taper off even more, and right around, I took this actually last week, and we're seeing more of a 120 pip range right now that the euro dollar is holding on a day-to-day basis. So this is actually one of the gauges that I use to monitor market volatility. Yes. Yeah, 14-day period. Yep. So whenever you guys want to tack this on, they just ask you for the period, and you would just put 14-period day, and then it'll just take that into account. So, and I use a daily chart for this because I want to see the daily moves rather than intraday moves. Yes. Trading station should have it. Yes. So now back to spreads. So here's a quick table that we have that we compiled and this is all the data that we got from FXCM. So here's basically the spread that we have between the bid and ask, and basically one thing that we can clearly see here is the spread to bid. It's relatively low as we trade more of the major currencies, but at the same time, when we look to more exotic pairs, and one thing that's really surprising here is we see a lot of our traders, our retail traders, they actually really favor the pound yen. But one thing that we could see is pound yen is relatively high on that cost list compared to other pairs such as the pound dollar or even the euro pound. So, just by taking a quick gauge of what's going on in this table, you might not want to, like, let's just say when we're trading the news, I certainly would not look at the pound yen. And a lot of our customers that come on to these live events, they always ask me, David, so why aren't we looking at the pound yen? One thing that we clearly see is the pound yen is less liquid, and there's a lot of higher cost associated with this. And that's why typically when I host trading in the news, one thing I typically look at is the major crosses, which is going to be the euro dollar or the pound dollar, anything that has the dollar as a cross rate. So one thing that we always want when we're trading on a day-to-day basis is the low spread from the ATR ratio. Because we know how much it moves on a day-to-day basis, we're really looking at the cost behind that. So one thing that we've outlined here is the spread compared to the ATR. So we see that the best currency throughout this section is really the euro dollar. And one thing that we always denote as the euro dollar is it's the most liquid currency out of all the major crosses. So typically when I'm trading a euro event or even a US event, that's the main currency that I typically focus on, and it's really a result of because all this data that we see compiled for the major currencies. So global trading hours. So these are all in Eastern Standard Time. So I've gotten a lot of questions about this, but basically this is how, this is basically how the 24-hour market works for the currency market. Is we see Asia starting 1900. So it's easier when we take a look at this from Sunday or Monday point of view, the beginning of the week. So when it's still Sunday evening in New York, or 1900 in New York, that's when we see the Asian markets open. So it crosses all the way into Monday now. So this is Monday, 0 Eastern Monday in New York. That's when we see the Asian session continue. And right when it's about to close, that's when we see the European markets come online. But the best thing that we see here is when the European markets are in kind of their midday trading, that's when we actually see the U.S. market open up. And that's when typically we see the highest level of liquidity at the same time as the highest level of volatility coming across the currency market. And of course, this is all based on the developments that we found at FXCM. So one thing that we denote here is there's always deeper liquidity when markets cross over. So taking a look at this next table this is just an average orders per hour that we see at FXCM. So one thing to denote here is, starting around 0-100 GMT, 0-100 Eastern Standard Time, liquidity is very low. We only see about 200 orders coming in right until 2 in the morning, and then we see it continue to rise until we get to that European session open, and that's when we really see it jump all the way close to 600 orders per hour. But one thing to note here is it kind of fluctuates in between those European figures until we really get to that US Open. And right when it opens, we see it all the way jump all the way to around 600 to 700. And we see it continue to gain pace as we go more into the US session. But one thing to keep in mind here is right around noon, New York time, that's when we really see market volatility or market liquidity start to taper off, just because that's the time that the European markets are closing. So these are certain time frames that, depending on what you're looking for, if you're looking for a lot of volatility, these are certainly the times that you want to be in and out of the markets. So one thing we always say, one thing that we always recommend, yes? Yeah, this is got from all the orders that we're getting in per hour. So one thing to keep in mind here, though. No, this is just proprietary data that we just compiled for the presentations here. When we upload all these presentations onto the website, and I believe we're developing another website just for these events that we had here, they will be all available. So So basically, the one thing that we want to do here is look at the market condition, and is this market condition really favorable to a lot of volatility and the type of liquidity that I'm looking for? So typically, if you're looking for a lot of volatility, a lot of liquidity, certainly these times up here, we certainly want to discount that and not be in the markets, and we might want to wait until we see liquidity start picking up around the European market open. So one thing to keep in mind, though, is certainly volatility can work against us. If we see a lot of movements in the exchange rates, that could certainly raise the risk for loss. So really, if you want some decent amount of volatility as well as liquidity, European markets seem really ideal, or right after the close of the European markets is also a good time to come into the markets. Well, typically what happens is because there's more traders coming in, which is liquidity, and we certainly see a lot of that, it tends to produce more volatility. Yes. Pretty much. Yes. Of course. Yes. Yeah. So during these times, so just based on what we see here, when the markets come online, more traders come into the market. That's when we typically see a lot of volatility flow in because of the rise in liquidity that we're seeing. But at the same time, when markets are thin and when orders aren't able to really be executed in a highly liquid market, that's when we might actually see a lot of volatility because there's a lot of jump or choppy price action going on. So one index I always like to look at is the relative strength index, and I typically like to use this on an intraday basis because it really gauges the magnitude of gains against the magnitude of losses over a given period of time. And it's really simple because it really just smooths out the momentum that we're seeing in the market. And one thing that, that if we take a look at this calculation of the RSI, it's all it basically is the average of days up closes above over the average of day closes lower. And X is just, we typically use a 14-period RSI as well by textbook definition. And this is one of the indicators that I really like to look at when I'm trading on an intraday basis. So we actually ran a study based on our RSI strategy at dailyfx.com. And you could actually find this on our website under our scalping section. And this is just one of the primes example that we clearly see that can favor scalp trading, where we see using the RSI, and this was the basic strategy that we used, buy when the 14-period RSI crosses above 30, and we sell when RSI crosses below 70. And typically, when we look at the RSI on an intraday basis, it's very volatile, and this is why we just try to pick these simple rules for this RSI strategy that we were testing out. So one thing to keep note here, and is one of the assumptions that we use, is there's no transaction cost here. But one thing that we see is during this 2-year span, this 3-year span that we were looking at, is it came almost up to producing $40,000 from almost $40,000 in our equity curve that we were looking at. But at the same time, one thing to note here is that there was 7.8K trades that we took over that 3-year span. So even if we say we got the best spread and we only paid minimal spread, certainly that 7.8K trades will certainly take a toll on our profits. And that's always one thing to keep in mind, is because we're trading so often in a one-day span, those costs are going to become really important as we trade on a short-term basis. We did it on a 1-minute chart, and this is from 2007 from all the way to 2009. Yes. Well, again, we basically put up this example because one thing to keep in mind here is that, yes, when we take out costs, it looks very profitable. But once we add the costs in, it definitely varies. And these are just one of the strategies that we were running. And we really run a lot of strategies at dailyfx.com, and we really try to, try to build proprietary systems that can really benefit our customers. But at times it's really difficult because we have these costs associated with trading currencies. So another strategy that I'll be discussing today is the grid strategy. So for those of you that aren't really too familiar with the grid strategy, it's actually not only used by a lot of FX traders, but it's used by a lot of equity traders as well. And it's a very simple strategy, and I'll keep it simple. But basically all we're doing is we're focusing on catching the ups and downs on a daily basis, and we're also focusing on intraday volatility. And we also, the one thing that we standardize in this strategy is our buy and sell orders will be very consistent, and typically all we do is if we set, and in my example I set 10 pip interval, is if we get a move in our favor, it triggers our entry, we look for that 10 pip rally, and then once it hits my 10 pip rally, I'll close that position and immediately open a new one and look for another 10 pip higher. But we'll go through the strategy, and I'll certainly talk about, sometimes it could be profitable, but again, there are a lot of caveats to a lot of these trading strategies. So here we just have, this is just an example that I made, and this is from April 1st that we saw. So one thing that we see is it's right around 0 to 100 Eastern time, and one thing that we're seeing is price action is really moving up and down right around that 150, 135 level. So initially that will be the level that I'll look to start, or that I'll begin. So first thing I'll do is I'll set 10 pip intervals, because we saw the high right around, and this is within the first hour of trading. We see that the high is at 135.08, and it's at 130, and the low is at 134.95. So it's really holding a tight range right now. So if I do see a break higher, and again, this is the first hour trading, so if I do see a break higher, I'll look to buy in at 10 pips higher. But if I see a break below, I'll certainly set my target. So I'm starting at 135, and basically here's what's happening. So I set my entries 10 pips higher, 135.10, and my short entry at 134.90. So this is after 2 hours of trading, what initially happens after I saw what happened in the first hour. So walking through this, we see that towards 130, we see that the buy entry gets filled, and I'm just looking to pick up that 10 pips to the upside right now. So this is right at 2 Eastern, but this is what happens an hour later. So, and this is where we get all the caveats with a lot of these trading strategies. Is we saw the entry get filled at right around 130, but it didn't actually climb as high as I expected, and it didn't really fill that order or that target that I was looking at 135.20. And as a result, what we see happening is it actually comes back down, and it continues to fall lower, and it actually fills my sell entry at 134.90. So what happens here is I'm still carrying the loss from this, but at the same time, it triggered my lower. And what we see at the end of the 3 hours of trading is it actually reaches that target that I set up for the lower bound 10 pips lower. So certainly one thing that's very positive here is we observed the gains on one, but we're still carrying the loss from that initial position that we opened up at the beginning of the day. So here's kind of how the grid strategy will look essentially. So, and I'll walk through this as we go on. So here right around 130, we saw it fill. We saw our order fill, and then we see it come down, and it actually picked up. And that's where we see again over here is our order gets filled, but we're certainly carrying that loss all the way up to here. And again, so just fast forwarding through all this, we still have that short position that was triggered here at the second level, which was at 134.80, and we're still carrying that position, and then it finally hits profit, and then we start to book some more profits as we see price action continue to climb lower. But ultimately what we see here is this last order that we were looking at does not get filled. So what ends up happening is we see an adverse move in the market. So essentially what happens is we have this order at 134.60, and that's was actually the low was at 134.60. So it just got triggered, but doesn't climb all the way down to 134.50, which would allow us to close out that position. And we see it actually reversing higher, and we continue to carry the losses from here. But on the flip side, one thing we see here is as it moves higher, we finally get to close that initial position that we had from 135.10, and it continues to push higher, and it continues to trigger our buy entry orders above. But one thing again is we're carrying that loss. So in essence, it's really hard, and as one of our guests mentioned, we might just place a stop. But it's really difficult to determine that when we're really trading on such a short-term basis. So again, one thing to keep in mind here, and this is just, I just did this myself, and one thing we're doing is we're just trying to trade the trend. The intraday range on the day. So essentially, what we're trying to do here is, we sort of we sold at this level, but it didn't really reach. It hit the target, and we're trying to sell it again. And certainly, and that's where you would have to use your discretion. But typically, when we ran these strategies, we actually computed them in, and that's why, it wasn't really placed in with a stop. We just were trading. We were just really testing out a lot of these strategies. So yeah, if I scroll back, yeah. No, it wasn't that I was hedging. It's essentially I was taking two different positions, yeah. Essentially what the grid strategy does is typically if you're an individual investor is, and this is what we try to play out, is we had two different accounts. And one was for the long side and the other one was for the short side. And that's essentially what we were trying to do, but it was just a strategy that we were trying to test out. Yeah. Well, we could see that sometimes it works and sometimes it doesn't. There's certainly a lot of caveats to a lot of these strategies, and this is why we're saying that there's a lot of risk involved. And if you're really inclined to trade it, and again, this is more of an automated strategy. But for those of you that follow our Trading the News, that's more discretionary, and we found that using more of our discretion can sometimes be better than trying to use some of these automated strategies because, again, it might not be able to produce the results that we actually want. So one thing that we continue to see here is we're continuing to ride that loss from here, right around that sell entry from 134.70. So basically, one thing that we really see is using the grid strategy. Yes. Well, essentially, what the grid strategy does, it's just an automated strategy. That's why what we did with these strategies is we actually tested it on two different accounts. So one is just going to go long, and the other one is going short. We didn't place it on the same account. So basically what we found by the strategy is...
I think we're all struggling with how silly the strategy is.
In essence, it is, but these are one of the strategies where, you guys could feel free to Google search it. It's a big topic amongst a lot of traders there. Not only in FX trading, but it's really a big topic in equity traders as well. And this is just the prime example that I use where it really makes no sense to use it. And this is why one of the things I want to stress here at today's presentation is that some people like scalp trading. It certainly works for some people, but when we're trying to come up with automated strategies and when we're trying to really just scalp the market every day, it's very difficult. And that's why one thing we're trying to get to here today is if you're really into scalp trading, there's certain conditions that you want to meet before you even look at trading the market on an intraday basis. And as I mentioned, looking at the time, the volatility, as well as the liquidity of the market certainly can help. But again, just like trading any financial product, using a strategy like this it has a lot of risk entailed. And this is why, this is just, and I'm really glad that we didn't put any money in this. We just, it was just more of a demo trading that we were trying to accomplish because we heard of the grid strategy and we try to use a lot of different strategies just to see whether it would work or not. And basically, we're just trying to see how it would develop amongst our own findings. So because we have the spread, we need to make, or we need a movement of 100 times to make up that spread. So it just depends on what the spread is. Yeah, and if you trade 100 times, you're going to need 100 pips just to break even. Because, yeah, there's always, every time you enter one position, you're paying one pip already. So, and that's where, and these are just some of the hurdles that we overcome when we're trying to scalp trade. And this is why, one thing that we do at dailyfx.com is Trading the News, because that's one trade that we just try to typically go in at we go in 2 lots. And we're just looking for a short-term a rally where we could pick up maybe anywhere between 20 to 40 pips, where we're just really looking at the cost of trading 2 lots. And another thing we want is certainly good execution. So slippage can really take a big toll on something like the grid strategy if the orders aren't getting filled on time. And again, slippage is always a big risk of what happens. And that's why when we do Trading the News on dailyfx.com, we typically focus on the events that that come out during the times where there's a lot of liquidity in the market, typically the U.S. Open or the European Open, where we see all the markets come online. And these are just some of the things or the steps that we take to minimize that risk for not our orders getting filled or that risk for slippage. So another risk factor for trying to trade on an intraday basis is economic releases. So for those of you that are familiar with our DailyFX economic calendar, there's anywhere between 120 to 160 events lined up for the week. And they all come out, some of them come out at the same time. So a lot of the U.S. releases, we see it comes out around 13:30 GMT, but just ahead of that, we see some Canadian data that could certainly affect what's going on in the currency market, namely in the dollar CAD. But at the same time, we might have a whole bunch of U.S. events lined up right after 8:30. So typically what we see, and for those of you that know are trading the news report, we always expect to see increased volatility when we see these economic releases flow into the markets. And certainly some of these events could produce adverse effects, or it could certainly work against us, especially if we're already in a position ahead of these releases. So this is another example that we have from our website, and you can find this under the scalping section. But here we see volatility, and it's really volatility typically is low ahead of these major news releases. So if you're a scalp trader and you're just trying to do it, and if you're really comfortable with just picking up little pips, you might want to trade this tight range that we're seeing right here. You can certainly try to buy in, just look for maybe a 10-pip gain, 5-pip gain, and just sell out real quick. But one thing that we see is once that non-farm payrolls release crosses the wires, and typically the non-farm payrolls is one of the biggest market movers that we've seen throughout history, but one thing that we see is volatility really picks up during that release. And certainly, I would say if we saw this sort of top of that really narrow range that we saw and we were trying to short it, it would have certainly worked against us and we could have ended up with a big loss unless we placed a stop. So again, when we're really looking for these small term or these really small gains, we really want to weigh what we're getting into, and we really want to know what we're doing because, again, certain market conditions, and we certainly see that when the U.S. market opens, is volatility or volatility remains low here, but until we get that economic release, that's when we see really a big spike in volatility. So, and one thing that we see is spread returns to normal, and the market works out in a consistent direction following this release. So basically, the strategy that we were using here, it would no longer be valid when we see price action moving higher. And then when we're trading on that intraday basis, we would certainly have to be able to adapt our strategies really quickly, unless we would have missed out on that as well. So trading on an intraday basis it's really difficult, and certainly the things that we do promote in Daily FX, which is basically the trading news, because it really sets up the conditions that are favorable to trading on an intraday basis. That's one of the things we do there. But as some of these strategies that we just went over today, some of them can be really risky and could actually produce a lot of loss. So additional guidelines is, as I mentioned, is adapting the strategies to market conditions. Just because we see the euro dollar holding 100 pip to 150 pip range on the day, it doesn't necessarily mean that we're going to be able to actually catch all those movements within a certain day, and it might actually work against us. But at the same time, we want to use appropriate leverage when we're trading on that intraday basis because, again, there's a lot of volatility, and once volatility really shoots through the roof, we could certainly expect increased momentum, increased volatility as liquidity increases. And again, leverage is a double-edged sword. So if we're actually were able to be on the right side of the market, that could have really helped us to pick up some big gains. But at the same time, if we were wrong and when we were on the opposite side of the market, that would certainly increase our risk for losses as well. And the one thing to keep in mind here for those of you that like to scalp trade or that are looking at it is we want to really set reasonable targets. So because we see the euro dollar moving 100 pips a day, I necessarily wouldn't be looking for an 80 pip gain on a day. That would mean there would only be 20 pip. We would only allow 20 pips moves in the opposite direction, and really it's hard to determine whether we're going to see that every day, especially when there's a lot of, especially nowadays where we see a lot of market news come out, and as we just saw, these news releases that come out throughout the whole session sparks a lot of volatility, which could certainly work against us. So I just want to thank you all for joining me today, and I certainly wish you all good luck in trading, and I'll certainly take a few questions right now.
So how would, in your slide, if you back there,
Mm-hmm.
the overall chart,
Mm-hmm.
that was it.
This one, yes.
So where the market's consolidated in the square.
Mm-hmm. Mm-hmm.
Okay. That's the only time that you really should attempt to scalp.
Yes. I mean, essentially, that's where we see conditions. It's really where we see, so looking at the time, we know that the European market is still in session. And yeah.
So
Yes.
I know the fortune.
Mm-hmm.
But I mentioned before, one of the big problems that I see with scalping is the upside down risk selection.
Mm-hmm.
The other thing that I see is that the shorter the time frame that you're trading, no matter what you're doing,
Mm-hmm.
when you're trading very short perspective, you're going to, intraday, but I mean 5 minutes versus an hour.
Mm-hmm.
As your time frame comes down,
Mm-hmm.
your signal to noise ratio increases.
Yes.
Right?
Yes.
The noise, the volatility,
Mm-hmm.
there's always some level of noise on any signal.
Mm-hmm.
And at very short periods of time, as you come down, that signal to noise ratio increases.
Mm-hmm.
So it's more and more dangerous because, in fact, it's that reduced signal to noise ratio
Mm-hmm.
that causes you to have the big upside down risk reward thing because
Yeah.
it's flying around more
Mm-hmm.
than what you, if you're looking for a 10-pip gain,
Mm-hmm.
it may be flailing at 30 or 40 pips.
Yeah.
So you've got to allow 40, 50, 60 pips anyway
Yeah.
of
Mm-hmm.
room, or you're just going to get stopped out by noise,
Yeah.
which is
That's why, what we do at Daily Effects, and the only thing that we really try to do here is where we really try to assess all those risks that we have, and that's why one thing that we do at Daily Effects is trade the news, because we know that that's going to produce some volatility, and if we're able to make the right call, it could certainly.
you scalp during volatility, is that what you're saying?
Yeah, we try to scalp when the volatility comes because essentially it could set the direction for the day. Yeah, that's why we kind of pulled out that non-farm payrolls report, and that's one of our.
You don't trade, you don't try to scalp while it's consolidating. You're really looking for a breakout.
Well, because what we see here is, at most you might pick up 5-10 pips here during this range, but we see that upside here or these movements here. It could certainly be more profitable in doing that than trying to trade these tight ranges where we might see an order that might carry through because of that event that crosses the wires. And that's why at Daily Effects, we spend a lot of time doing trading the news because, again, it's very risky trying to trade on an intraday basis. And we host webinars on this on a weekly basis. And, we try to help out all our customers and, try to give our insights of what we expect and kind of the market reactions that we're seeing. Yes?
A suggestion was made in the question that,
Mm-hmm.
that somebody could make a killing doing scalping.
Yeah.
Is that true? Do you have customers that make a killing?
Some people actually are very successful in doing so. And again, it's really based on their trading style. So some people, they have certain indicators that they like to use. But as for...
Consistently over time?
I wouldn't say so consistently. It always varies on market conditions. And that's why it really depends on the type of individual, because one thing we're doing here is during this consolidation phase, we might feel very comfortable in trading that range. But once we see all this volatility, we're all humans here, and all our emotions get to us, especially when our real money's on the line, and that's when it gets really difficult to trade that. And that's why I went over the grid strategy, because that's something that it really takes away all our emotions, and we just have that set price of where we're going to enter and where we're looking to bank our profits.
What was the net result in your grid strategy? Did it make money?
Essentially, we let it ride for a couple of days, and it didn't work out too well. Yeah. Yes. So I'm typically in the office on Eastern Standard Time. I'm in there by 5 a.m. I typically like to catch the European markets. Yeah, so I usually like to come in right before or right after the European markets come in. I'll spend a few minutes trying to assess what happened in Asia trading, and I'm usually there until anywhere between 3 to 4 p.m. Eastern Standard Time, because I really like to see what's going to happen as we head into the Asian session. So those are the hours we're there. New York. So, yes. Again, slippage really happens a lot when liquidity is very thin. So, I showed you guys a chart of where we see a lot of orders. So the more orders there are, it tends to give another side of your position to be met. So that's typically when we see less slippage, and that's why when we're doing trading the news, we only pick events, or we try to pick events that where we see enough liquidity in the markets where when we're trying to enter in really short, we know, or there is that higher risk that our orders will get filled at where we want them to be filled. Yes. Sure. Sure. Mm-hmm. Mm-hmm. Sounds good. So, is there any other questions? Or yes. Typically, when we do trading the news, we do use limits and we use stops. But for that grid strategy, yeah. So typically, when I'm trading the news, and especially given what we see in the market conditions right now, if we're seeing 120 to maybe even 150 pip range, I would typically pick my stops anywhere between 20 to 30 pips, 20 30 pips. Mm-hmm. Mm-hmm. Yeah. So I mean, this is the key example of that is European markets don't move anywhere until that U.S. market opens, and we really see a lot of people pricing in that ahead of the time, and that's why in the beginning of the week we might see nothing really happen, only really a lot of the short-term ranges holding until we get to that Friday's non-farm payrolls. Yes. Well, the only thing that we really see, and given all the access that we have to our data that we see is, on Friday we definitely see market liquidity thin out ahead of the weekend. But I would say because it thins out, it's really hard to gauge whether it's a clear signal or not. And it certainly changes week to week because I would say if a big event is coming up on that Monday or something early that following week, we typically see a lot of our open interest actually fall off or taper off ahead of that. And typically that's the same strategy I use is once it hits Friday, I really don't look to open any new trades, and I'll just sit pat and wait till Monday until I get into the office on Monday to really see what might happen throughout the week.
I don't trade anymore.
Yeah. Mm-hmm. 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 Mm. Mm-hmm. Well, actually, for those of you that know Jamie, he actually conducted a study on that, and yeah, and he actually said something about the first day of the month, and and you could ask him. He's probably at the booth right now, and he actually discovers a lot of these things, and he really focuses on what happens during first day of trading of the week, as well as what happens during the first day of the month. And he'll definitely be able to go into more detail about that. And I know he runs spreadsheets all the times based on what he's looking at. So certainly, we do see market liquidity turns back on Monday. So I would say, Monday is typically the day that I would look to maybe initiate a trade. Yeah, I mean, that's when I would, if there are good opportunities, I'll certainly will jump into a trade on Monday, but it really happens on, but if we see that low liquidity continue or low volatility continue carrying into Monday.
You know what else I've noticed is when the market opens,
It's really thin.
it's always a good spot.
Yeah, it's.
I mean, you can really just look at what's happening in the first hour.
Mm-hmm. And typically,
Take a trade, take a couple of hours trade in that direction.
And typically that happens, as the gentleman mentioned before, it's typically because liquidity is very thin during that time. And that's why we see a lot of choppy price action, and essentially that's what happens when we see it open in New York. It's Sunday evening what we see. So, yeah. Thank you. So I'll be around for a few minutes if any of you have any questions. But again, I really want to thank all you guys for joining here, and I hope you enjoy your rest of the stay here.